We're wondering what in the U.S. is the weak link. Is it our pensions? Well, if not that, what are some of the weak links that we're seeing? The pipeline is full of deflationary indicators, starting from commodities, and we'll get into that in a moment. And so we think this is a bit of a financial crisis.
Cathie Wood of ARC Innovation looked like a genius in 2020 as her innovation-focused fund rose 120% in a 12-month period. However, since then, ARC has given all of those profits back. In our opinion, her thesis that innovation forces will be a powerful driver this decade is absolutely correct. However, what we said at the time, and what has proven to be correct, is that she drastically underestimated the power of the Fed's involvement and the horrible macro environment. Her portfolio's performance has suffered as a result. She stands by her belief the Fed's bigger concern should be deflation and not inflation in the medium to long term. She adds that the Fed is misreading the economic tea leaves in a big way, and they are going to cause a massive deflationary event. A great opportunity for us to pick up bargains, so watch until the end. In this essential investing highlight, Cathie explains why the Fed is getting it so wrong and where these bargains will show up first.
Chairman Powell really does think he is the reincarnation of Chairman Volcker, that we need him to take a sledgehammer to inflation, much like Volcker did. And history has treated Chairman Volcker very kindly. He did turn the tide on inflation. Now, what he did, though, was he turned a tide that had been building for 15 years. It started in 1964 with the Vietnam War and with the Great Society. So many social programs started at that time under President Johnson. And for 15 years, fiscal and monetary policy pretty much went rogue as we look at history. Even after shocks to the system, like the oil embargo and the stimulus that came about because of it, both monetary and fiscal policy, we never saw the kind of slowdown in monetary and fiscal policy that we're seeing right now. Federal spending is still down 14% on a year-over-year basis. You never saw a decline in fiscal policy spending in the 70s. Monetary policy seemed to be on automatic pilot back then. The dollar was getting crushed toward the end of the 70s, adding to the inflationary fire. So Chairman Volcker did choke off money supply and killed inflation. It took a long time for people to believe that inflation had peaked. In fact, I don't think many people believe it peaked, as it did in 1981, until 1986 when oil prices crashed. So the inflation expectations were embedded in the system, and it was very difficult, and Volcker did a masterful job. So that was over a 15-year period that inflation had built. By the time the Fed got around to tackling it this time, it was not a 15-year problem, it was a 15-month problem. And from our point of view, it was caused primarily by shocks, major shocks to the system that we had never seen before. We had not had, since Spanish influenza, a global pandemic. And we did not have the supply chain problems, 2 years worth of them, that we had because of the COVID panic. And then, of course, we had another shock to top those off, and that was Russia's invasion of Ukraine. So these are shocks to the system. This was not a period of embedding inflation expectations, and yet Chairman Powell is taking a sledgehammer that is actually bigger, much bigger. It's at least 6 times bigger right now, and could be 8 to 10 times bigger if the Fed does raise the Fed funds rate another 75 basis points on November 2nd. And what do I mean by that? Well, Chairman Volcker was dealing with double-digit interest rates. He took interest rates from 10% to 20%. Now, by the time he did that, consumers and businesses had gotten used to maneuvering around inflation. So while that sounds shocking, going from 10 to 20%, and it did have some shock value, it wasn't the same as what we're experiencing today with Chairman Powell and the Fed. Today, we've gone from 0.25% on the Fed funds rate to 3.25, which is a 13-fold increase, not a two-fold increase. Now, many people, I was interviewed by someone the other day and said, oh yeah, but that was such a low base. There's no comparison. In fact, that makes this even more dramatic. That's what's so interesting. People dismiss this way of thinking about it, saying, oh yeah, but the base was so low. The base was so low, and it had been really since 2008 and 9, because we were in a terrible crisis then. It took a long time to get out of it. And so we did not have inflation expectations built into the system. I really don't believe at all. And yet Chairman Powell is behaving as though what's going on today with inflation is much worse than what Volcker inherited. Starting from a low base is really shocking the system, especially given how long interest rates have been low. So I question the premise of those who say, oh, this is so different, it's such a low base. That's the whole point, it's a low base, 13 times.
So deflation is coming, and coming fast, according to Cathie. In the next sequence, she says that in fact it already has started and the signs are already here. If today's Essential Investing episode helped keep you informed, share the love by smashing that like button because, well, it's just good karma. And subscribe and hit the bell so you get immediate notification of tomorrow's video, where famed Swiss investor and eternally grumpy sounding Mark Faber reveals what he believes is the most dangerous asset to hold right now that I almost guarantee is currently in your portfolio. Can you guess?
Retailers are awash in inventories, and the latest one, pretty provocative, is Nike, and Nike is both a retailer, but it mostly sells to retail. Nike's inventories, well, first of all, its global sales were up 3% in this last quarter. Its inventories increased 44%. And that's an August quarter. There were already telltale signs that the consumer was weakening. Its North American inventories were up 68%. And the inventories in transit, mostly from Asia, were up, so they're on ships, were up 85%. So you know what's going to happen. In order to clear the shelves, Nike is going to have to cut prices, and retailers will as well. And we believe this is just a microcosm of a much broader problem out there. And we think we'll see it in full force this holiday season. So you should look for and demand bargain basement pricing this holiday season. Commodity prices, again, data-driven Fed. Are you listening? So we'll start with, from their peaks, we've got the gold price down 17%, copper down 30%, lumber down 73%. Think about that. Housing is collapsing. Iron ore down 45%. Infrastructure around the world has run into trouble, especially China. Corn down 17%. Silver down 29%. DRAM prices, which are chips, semiconductors, down 46%. The Baltic Freight Index down 48%. That's an indicator of supply chain issues. The Baltic Freight Dry Index, which is just for dry goods, down 65%. Oil down 29%. And many people have been dismissing these as saying, yeah, but that's, they went to sky high prices. They're still not down on a year-over-year basis. That's not true anymore. Gold is down 3%. Copper is down 17%. This is as of today. Lumber is down 28% on a year-over-year basis. Corn is an exception. It is up 27%. Again, Ukraine being a big problem there. We have silver down 9%. DRAM prices down 33%, the Baltic Dry Freight Index down 65%, and oil is up 14%. That's as of today. It's had a big pop recently, but we do think, having come down from $130 to $90, it is in a downtrend. mostly because of demand destruction.
I highly recommend checking out this video where dollar milkshake theory proponent Brent Johnson updates us on how the dollar wrecking ball is playing out on its predictable path and what to expect next.